Again, pretty much the same kind of call with the other banks there. It's a valuation thing. They're talking about how it better reflects, the stock now better reflects what they think is the long-term view of the company, and downgrading to neutral not as an overweight kind of position for investors. Talking about things like, they didn't see the run-up coming, right? They didn't see it coming, but they're surprised by it. But they think it's due to things like reports of better sales in April and May, not official reports, but just reports. Less discounting than they thought. The Model 3 getting the full tax credit, the charging deals, and then of course the AI sort of frenzy. So,
in recent days, Tesla stock has been downgraded by several firms. As can be expected, that didn't help the company's stock any. A few days ago, Tesla stock sank 5.5%, its steepest loss in 2 months, after a Wall Street analyst cautioned it was time to take some money off the table. In a note to investors, Barclays analyst Dan Levy downgraded Tesla shares to equal weight from overweight, claiming the recent rally ignored near-term questions about the stock's fundamentals. Though Tesla doesn't exactly trade on fundamentals as it currently trades at a forward PE of 80, Levy made some interesting points about where Tesla stock sits compared to only a month ago. We believe the stock's recent rally can be best explained by the market's current AI-driven thematic trade, as well as excitement over recent announcements to open the Tesla Supercharger network to other brands, Levy said in his note. Yet, while we aren't surprised that the stock has participated in the rally, we believe it is prudent to move to the sidelines. Levy's main thesis for the downgrade rests on 3 main points: the AI effect that may be overblown, Tesla's recent supercharger deals and uncertain benefits, and, most importantly, how multiple expansion is the entirety of the rally. As for AI, the recent run-up in Nvidia and other AI-related stocks that looped in Tesla made sense because of the company's ventures, like FSD, full self-driving, its Dojo supercomputer, and the Optimus robot. Though somewhat ironically, CEO Elon Musk has warned about the dangers of AI. Levy, however, believes AI is a long-dated opportunity for Tesla, not something that can be counted on right now to considerably boost its valuation. Levy believes Tesla's 2024 consensus EPS estimates are still too rosy and need to be brought down. In addition, Tesla's margins are still uncertain given recent price cuts, though its possible margins may have troughed. Finally, more price cuts may be necessary as Model 3 inventories look bloated, and increased Model Y production in Giga Austin and Berlin may necessitate further price reductions, again hurting margins. Still, the Barclays analyst remains to be long-term bullish on Tesla's prospects, just not a buyer at these levels. We continue to see Tesla as the long-term winner amongst OEMs in the race to an EV world, Levy says, but near-term fundamentals need to be considered. Goldman Sachs, an American multinational investment bank and financial services company, too downgraded Tesla stock from buy to neutral. That said, the EV company's stocks were once again affected negatively. We're downgrading shares to neutral from buy as we believe the stock now better reflects our positive long-term view of the company's growth positioning, said the bank's analyst in a note to clients dated Sunday. Tesla shares TSLA, plus 3.8%, fell 2.3% ahead of Wall Street's open. While the primary reason for the change is that we think the market is now giving the stock more credit for its longer-term opportunities post the recent rally, we're also cognizant of the difficult environment for new vehicles that we think will continue to weigh on Tesla's automotive non-GAAP gross margin this year, said a team led by analyst Mark Delaney. However, their price target of $185 was increased to $248. The update came amidst Tesla stock's recent rally, which saw the EV maker's shares rising 108% year-to-date. In light of this, even with its pullback, Tesla stock still ended at $256.60 per share a few days ago. This means that the electric vehicle maker had a market cap of $813 billion at the end of the past week. That's very impressive, and it suggests that the company has yet another shot at hitting and perhaps breaking the $1 trillion market cap mark in the coming months. Overall, we believe our view that Tesla is well positioned for long-term growth given its leading position in the EV and clean energy markets, which we attribute in part to its ability to offer full solutions including charging, storage, software, FSD, and services with a direct sale model, is now better reflected in the stock, Delaney noted. Even with the downgrades, the analyst clarified that they remain positive on EV adoption and continue to see the most investing opportunities among our broader set of suppliers, especially those with higher content to enable the shift to EVs and electrification. Likewise, Deutsche Bank adopts an optimistic Tesla stance ahead of its Q2 delivery report. Unlike the other firms who decided to downgrade Tesla stock, in a recent update, the firm reiterated its buy rating on the electric vehicle maker's stock, from $200 per share to $230 per share. The firm's estimates came just days ahead of the expected release of Tesla's Q2 2023 vehicle delivery and production report. With the end of the second quarter in sight, Tesla is expected to report its delivery and production numbers for Q2 sometime this weekend. With this in mind, Deutsche Bank opted to revise its estimates, with the firm expecting Tesla to deliver 448,000 vehicles in the second quarter. That's a 76% year-over-year increase and a 6% quarter-over-quarter growth. The firm estimates that Tesla would likely deliver 153 units of the Model 3 and Model Y in China and about 168,000 in North America. The bank also estimated that around 87,000 of Tesla's Q2 deliveries would be coming from Europe, and around 23,000 would be coming from the rest of the global market. In light of this, Deutsche Bank opted to raise its Q2 2023 revenue estimates to $24 billion, up $500 million from its previous estimate of $23.5 billion. In comparison, the Street's revenue estimate stands at $24.3 billion. The firm also raised its gross margin estimates for Tesla from down 200 BPS quarter-over-quarter previously to down 140 BPS quarter-over-quarter, as noted in an Investing.com report. Deutsche Bank also raised its Q2 EPS estimate from 73 cents to 79 cents in line with the Street's estimates. Beyond the quarter, we still see a risk of additional price cuts over the rest of the year and into 2024. At our recent DB Global Autos conference, Tesla reiterated it would continue to stay nimble with pricing, and while its costs will come down in the remainder of the year, the company indicated the more important question remains whether they will come down at the same pace as price should it need to take further cuts, the Deutsche Bank analyst noted. Meanwhile, Tesla CEO Elon Musk lashed out at S&P rating after Tesla scored lower than Philip Morris. Musk bashed environmental social governance as the devil after investment data firm S&P Global gave the electric car company a lower ESG score than Marlboro maker Philip Morris International. Why ESG is the devil? Musk tweeted on Tuesday in response to a reporter's coverage of the ESG results, which showed Tesla receiving a dismal 37 out of 100, while the cancer-causing cigarette maker scored a shocking 84. How could cigarettes, which kill over 8 million a year, be deemed a more ethical investment than electric cars? Washington Free Beacon journalist Aaron Sibarium tweeted, "One answer, tobacco's gone woke," he added, to which Musk replied with his condemnation of ESG. To determine the ESG scores, S&P analyzed 8,000 companies for 1,000 data points, including climate strategies, labor practices, stakeholder engagement, codes of business conduct, and board diversity, among many others, according to its website. Tesla's medium score of 37 was the amalgamation of its environmental, social, and governance ratings, which were 60, 20, and 34 respectively. An S&P Global spokesperson said that company scores are comparable within the relevant sector rather than across industry groupings, noting that tobacco companies and automotive manufacturers are assessed on their performance and relative to their peers in their respective industries, not to each other. Still, do not fret. Tesla remains to be a market leader in the EV space, especially since Volvo became the fourth big-name automaker to announce support for Tesla's NACS EV charging connector after Ford, GM, and Rivian. According to the announcement, this arrangement is similar to the ones Tesla recently reached with several other car manufacturers. Volvo owners will get access to 12,000 Tesla supercharger stations, and Volvo EVs will be manufactured with a NACS port starting in 2025. For current Volvo EV owners, including XC40, C40 Recharge, and the upcoming EX30 and EX90, a Tesla NACS to CCS adapter will be provided to work by the middle of 2024. Volvo also said owners will be able to find the charging stations in its Volvo Cars app. The news came after the Automotive Standards Organization, known as SAE International, announced support for NACS to become a fully recognized standard. Volvo is following major auto manufacturers Ford, GM, and Rivian in adopting Tesla's plug, which is gaining momentum behind the current widely adopted Combined Charging System (CCS) standard. Electric vehicle charging station makers and operators like ChargePoint and EVgo have recently announced support as well. All that said, Tesla's charging technology is now believed to be on the fast track to becoming US standard, and this is just one reason why you shouldn't be bothered by firms downgrading Tesla. Make sure to subscribe for more.